So I'm going to change what I invest in each month. And in this video, I'm going to outline why, my thought process for this, and I'll also show you my process for deciding what fund I buy out of the sea of options that are available to us. I'm a global index fund investor. I'm going to continue to be basically till the day I die. But in order to explain the changes that are going on in my portfolio, let me just give you some context.
You have to do that? You have to, right? You have to.
Jack Bogle introduced the first retail index fund in 1976. It was labelled by the investment world as Jack's Folly. Considered un-American due to the low fees. Funny really, because the fund was actually all American. Now a classic S&P 500 fund. Initially it was slow to catch on, but as we went through the decades, the popularity of this passive style of investing grew. In 1992, Vanguard introduced what might be considered the first global fund. Well, not really. Vanguard's total stock market index fund was an American-focused fund again, but included businesses that had international operations. So it gave a little bit of international exposure. June 24th, 2008 was the first real global fund. And VWRL, the fund inside my stocks and shares ISA, first hit UK shores on the 22nd of July 2012. So why the history lesson?
Because you're boring!
Well, the world might be 4.5 billion years old, but funds that track global performance are barely in their teens. The space continues to evolve, but every so often, something comes along that catches my eye. So, you know what that means.
Yeah, we're gonna all get together and we're gonna go
I'm sure that you're fully aware people who write shopping lists spend less time shopping, make less impulsive purchases, save money, have better love lives, live longer, all of that. It's all well documented at this point. Well, I've got a shopping list that I use when I'm shopping for index funds. Let's just go through this and it will help us filter out the sea of options. Hargreaves Lansdown, who tend to have one of the largest selections of fund choices here in the UK, list 469 options under the global filter.
You forgot one.
This isn't actually where I invest. I keep an up-to-date list of all the brokers I use in the description of every video, but it serves to highlight a point that there are just a lot of options that we need to cut through. So first and foremost, my fund needs to be passive and not actively managed.
Ronnie's lifestyle depends on his ability to make money for his clients.
I don't want someone to be picking stocks on my behalf. The whole reason John set up Vanguard in the first place was because when studying at university, he realised that active fund managers failed to beat their benchmark index in most cases, especially when you considered their fees.
Bullish when they should have been bearish.
They had what was called a 2 and 20 model, so 2% of the fund value each year, and then 20% of any gains they made. You can see why John's passive index funds were hated so much. 50 years later though, index funds reign supreme, and it's still the case that active fund managers consistently underperform the market. The latest data from Standard & Poor's released at the end of 2022 showed that out of the actively managed 2,132 mutual funds, not a single one managed to beat the S&P 500 over 5 years. Not a single one. Now, before you Peter Lynch me in the comments, I'm sure Michael buried under a black rock somewhere there's an example of someone who's beat the market, but it's all just Cathy woulda, shoulda, coulda to me. One or two examples of survivorship bias in a sea of mediocre performance. Why risk active management and the associated fees when the track record is patchy at best and the alternative is cheaper with a historic track record of better performance? So yeah, passive funds for me please. Okay, next criteria. Basically, I just want my global fund to be, well, global.
Oh, world.
HL offering over 400 global options. If we look through these, we'll see all sorts of things. With or without emerging markets, without the UK, no fossil fuels, no pharma, all pharma, hundreds of combinations and configurations of what makes up the world. But the last time I checked, there was only one planet. And choosing to exclude sections of it for whatever reason is a bit like saying a national baseball competition is the World Series. Fund providers want you in their funds because then they can charge you fees. This is how we end up with 469 iterations of the world. Because fund providers are chasing demand and they just want to issue new funds for whatever the finance flavour is of the month. It's the finance equivalent of fast fashion. A few years ago, we saw green energy and car funds popping up everywhere, and now it looks like AI funds are all the rage. Or we could step back and say recently funds that have excluded the UK market, so a global fund minus the UK, has done pretty well. And considering the dystopian Black Mirror-esque nightmare that we all live in the UK at the minute, many of us might go, yeah, you know what? I think it's a good idea to leave the UK market out of the mix. I don't want to make that sort of decision because I believe that I'm terrible at it. And even if I have a view that I think is informed, I think it can be too influenced by what's going on around me. I'll show you what I mean with this paper from 2005 called Neurobiological Correlates of Social Conformity and Independence During Mental Rotation. I promise this is interesting.
He's lying! He's lying!
The paper focused on a study where they got a group of 5 people and then showed them shapes on a computer and asked them, if we spin these shapes around, will they fit together? They said it was a test on vision, but they lied. 4 of the 5 people in each group were a plant who would say yes to shapes that wouldn't fit together. So basically what they were testing here is, are people influenced by the incorrect answers of other people around them? Sort of like peer pressure or something. 30% of the test subjects gave the correct answer, and their brain scans showed that they experienced discomfort and apprehension when saying their answers. It was hard for them to go against the crowd, but this is where it gets even better. When asked, almost all of the group who got it wrong said they thought that they got the right answer. Only 3.4% of the people surveyed said that they knew the right answer but went along with the crowd. So this isn't about peer pressure, this is literally about a change in perception. The brain scans confirm this as well. Areas of the brain lit up that relate to perception, taste and feel. These people believed the answers to be true. They were influenced by the lies of others. It's why eyewitness accounts are so unreliable. It's why the world argued about the colour of this dress for a few days once. And it's why I won't expose myself to making choices around my core portfolio in terms of exposure, because my perceptions have probably been warped by the narratives of the day. I might think that I'm right, but honestly, that doesn't mean much at all. Really, knowledge is to know the extent of one's ignorance. I'm not the guy who can predict which way the world will be spinning in 30 years. For that reason, I want unfiltered global exposure with both emerging and developed markets. I mean, I could have just summed the whole thing up with that one line there, couldn't I? But you know I love a bit of drama on this channel. Let's keep the next thing on the shopping list short and sweet, shall we? I want the fund to be listed in pounds because that's my domestic currency. It means I don't have to pay any currency conversion fees. So here's a few options that I've honed in on. I buy these 2 already, which shows my criteria is being met by my screening process. It also brings up these 2 options though as well. I now want to look at the funds themselves and what they track in particular. Google search the name, look up the index it tracks, and then go take a look at what that index does. 3 of them track the same thing, the FTSE All World Index, and then this fund tracks the FTSE Global All Cap. So the question is, what is the difference and does that matter? If we look at what the indexes do broadly, we can see that the one major difference here is the inclusion of small cap companies. The all cap here relates to the fact that the fund includes companies of all sizes or all capitalizations. If we plot the performance of the all world and the all cap as proxies to the index itself, we can see that they have performed almost identically over the last 5 years, going up and down at the same time. Roman at PensionCraft made a similar video to this a month or 2 ago. I'll link it below. I think he's always worth listening to on these types of topics, and he's one of the only finance channels that I actively watch all of the time. He had a beautiful way of describing what's going on here, saying that global index funds have essentially become commoditized in the fact that they all offer the same thing pretty much. So I'm not too concerned about the underlying index. I know that all of these funds from major providers will do a pretty good job of tracking the index itself. You can quickly check that by looking at the performance versus the benchmark. Here is an example from Vanguard's VWRL fund. In green, this is what the index did, the index that they're tracking, and in red, this is what their fund did. Notice they're basically identical. Worth checking, especially if the fund provider is a little bit obscure. Okay, so the last 2 things I'm going to check or consider are the fees and then any platform-specific restrictions. So is the fund even on the platform that I want to use? Things like this. Some people would also consider the accumulation versus income debate. So are the dividends that you receive from the investments automatically reinvested for you, or do you have to do it yourself? Are they paid onto your brokerage account as income? I don't care either way. I'm slamming whatever dividends I get straight back into the fund anyway. It doesn't make any difference to me. So let's talk about fees. This really is why I made this whole video, and it's why I'm considering changing things up a bit. VWRL and VWRP, which is the accumulating version, and the FTSE Global All Cap all have fees of around 0.22% and 0.23%. Until this point, that's actually pretty cheap for global exposure that includes emerging markets. When you include emerging markets, you tend to pay more because these markets tend to be harder to trade. They're not as liquid or as easy to access as the developed markets like America. You can get developed market-only funds that have fees as little as 0.05%, which is incredibly low. I'm paying extra to access the emerging markets, and you might go, you know what, Damien, I'm not bothered. I'm just going to go without emerging markets, go developed market only, and then access a cheaper fund. Hopefully this video helps you make that decision with a little bit more certainty. But where I get excited though, is this Invesco FTSE All World UCITS ETF. This tracks the same index as VWRL, but does it for a fee of 0.15%. How big a difference does that make? On screen are 3 scenarios all over a 30-year investing time horizon. One at 100 a month, one at 500 a month, and one at 2k a month. The more you invest, the bigger the fee, so I wanted to show the higher ranges here. I've assumed a nominal growth rate of 8% as the base case here, and then we have the Invesco's fees and the Vanguard fees. So this is how much you would have in each case after 30 years. and here are the fees involved in that. At the top range, the difference between these two is £40,000 in extra fees. You might say, well, that's not much on a £3 million portfolio, but I mean, it's definitely something. Fees are the one thing as investors that we can control. And I must say, it makes little sense for me to continue to invest in a fund on a platform when there is another fund that does the exact same thing for a third cheaper. I guess the only thing you could say is that Vanguard, you have the brand reputation, the long track record behind it, but that reputation was built on being cheap. I think it's time that Vanguard chopped the fees on some of these funds, these global funds with emerging market exposure. In America, they offer this fund, which tracks the FTSE Global All Cap, excluding the US, for 0.07%. You can pick up the rest of the American component for 0.03%. Let's get some of those kinds of fees in the UK, please. I'll point out that the Invesco fund only has £10 million in assets under management at the minute. This is a brand new fund and it's very small, so that might put some people off. One concern is liquidity. Smaller funds have less people buying and selling them. This means that the difference between the buy and sell or bid and ask price can be larger. I've linked an article below that goes into this for you in more detail and shows how it can impact you. As a long-term investor who's looking to hold investments for decades though, I'm not too concerned about this, especially as I think the assets under management in this fund will increase significantly in the coming months, and I won't be selling anytime soon. Also, it's worth mentioning that a fund this small, there's always a risk that it gets closed down if it doesn't gain enough traction. But this is the cheapest all-world ETF on the market, so I suspect it will do well. I'll drip feed into the fund in the coming months myself. I'm not going to migrate all of my Vanguard holdings that I have on platforms like 212 into this fund until it's a bit larger. But yeah, this is a small fund, it's worth pointing out because I know that this is going to put some people off. But Invesco are huge, they have around 1.5 trillion under management as a group, and they come with a good reputation. So I am happy to be early here personally. Also, finally, on the platform bit, if you invest on Vanguard, you only have access to Vanguard's funds. My SIP is with Vanguard, and I'll be keeping the Global All Cap as my main investment there. And I'm really happy with this fund. I really like it. So I'm going to access this fund on InvestEngine and Trade in 212. They're the cheapest places to buy ETFs in the UK currently inside of an ISA. InvestEngine also have business investing as well. So for the money that I keep inside my limited company, I can invest that without taking it out of the business, which is great. I really hope that this fund promotes a bit of a race to the bottom now in terms of fees, and we see a continued evolution in this space, and we see more global funds with emerging market exposure at better prices here in the UK. At this point, you might be wondering, why don't you just invest in the S&P 500, Damien? Considering that's been the best investment to make in the last 10 years. Well, watch this video next where I discuss just that.